Last week, we talked about what it means to live inside uncertainty rather than crisis. We looked at how U.S.-China competition has shifted into a phase of managed risk, where support still exists, but guarantees feel thinner and more conditional. We unpacked mixed signals from Washington, China's steadily rising capabilities, and why Japan and Taiwan are quietly tightening ties as they adjust to a changing strategic environment. And we ended by looking forward at how chips and AI are becoming the long game, not just for growth, but for resilience and relevance. Now this week, we continue that conversation, except into the new year. Hi, you're listening to Beyond the Reefs, a show produced by Radio Taiwan International. Here we talk about socioeconomic issues that are faced by Taiwan and their broader impact around the world beyond the reefs of this island nation.
In the first hours of the new year, Taiwan President Lai Ching-te has a warning for his country.
Lai's
annual New Year's Day speech comes just after China wrapped up massive military drills around Taiwan, which it claims as its territory and has vowed to take by force if necessary. But it also comes as Taiwan's opposition-led legislature repeatedly blocks a record-high special defense budget meant to prepare Taiwan for a Chinese attack, and as the country's politics become increasingly polarized. In his speech, Lai urged lawmakers to pass the budget, saying the country needs to come together in prioritizing security, posing it as a matter of survival. There were more hopeful messages, too. Even as China tries to isolate Taiwan, Lai stressed how much support the country got last year from abroad, pointing to the U.S.'s recently announced $11 billion arms sale to Taiwan and its inclusion of Taiwan in its national security strategy. One analyst says Lai is hoping to reassure Taiwanese people who know that U.S. support will be crucial if China attacks. But just hours before, on the other side of the Taiwan Strait, Chinese President Xi Jinping gave a New Year's speech of his own, making clear that China will never give up on its goal of taking Taiwan. Both leaders also spent much of their speeches discussing domestic issues, like technological developments, the state of their economies, and political upheaval. But it's often their comments about one another that attract the most attention. The international community focused on any moves that could threaten the stability of the Taiwan Strait and ultimately the world.
The first week of a new year is usually when people take stock, not just of what happened, but where things are heading. And for Taiwan, the numbers at the end of 2025 look, at least on the surface, pretty strong. The stock market closed a year at record highs. AI-related companies kept pulling the economy forward. Consumer spending stayed resilient. In fact, some indicators are now flashing yellow to red, a polite way of saying growth may be running a little too hot. But let's take a step back, and the picture gets a little bit complicated because at the same time Taiwan is celebrating a strong year, uncertainty is still building around the relationship that matters most, trade with the United States. Tariff negotiations are still unresolved. Consumer confidence is already feeling the strain, and Taiwan's most important company, TSMC, now finds itself pulled in opposite directions, expanding production in the U.S. while keeping mature operations running in China. Add all of it up, and this doesn't feel like a simple success story. So Taiwan steps into 2026, and the question isn't whether the economy is strong, it's where Taiwan should go next and what trade-offs it's willing to accept along the way. Taiwan's stock market closed 2025 at an all-time high, capping off one of its strongest year in record. The Taipei Exchange surged nearly 26% over this year, logging its largest annual point gain ever. Driven roughly by heavyweight tech stocks like TSMC, market capitalization crossed 100 trillion new Taiwan dollars for the first time when OCT firms were included. AI-related demand spilled beyond chip foundries into memory, PCBs, servers, and data center infrastructure, pulling a wide swath of the market higher. So yes, again, like everywhere else around the world, especially in Taiwan and the US, Tech stocks lead the trend. And I'll say that continued investment by global providers is expected to support momentum into early 2026. Now, this kind of rally isn't just about optimism. It reflects real capital flowing into Taiwan's role in the global AI supply chain. But markets are pricing in continuity. Continued AI spending, stable demand for conditions, and sustained demands are all baked into valuation. This makes the upside narrower and the downside a little bit more sensitive to shocks. And there just might be some shocks coming our way in 2026. A record high is a milestone, but it also marks a point where expectations are doing more work than surprises. Strong markets don't signal safety. They signal confidence, but still needs to be tested. But this confidence grows because there's another headline about how Taiwan's stock market has outperformed both Japan and South Korea over the past 4 years, which for the last, I would say, 2 to 3 decades, along with Singapore, have been the main, rivalries of Taiwan's in Asia. Now, according to the central bank, with gains of roughly 120% since 2022, the performance rivals the US NASDAQ and reflects Taiwan's deep specialization in AI hardware. From advanced chips to server assembly, Taiwan is now accounting for around 90% of global AI server assembly, giving it a structural edge as AI demand accelerates worldwide. Officials argue that while liquidity and loose global monetary conditions help all markets, Taiwan's specialization explains its sustained outperformance. Now, outperformance sounds reassuring, but it also reveals concentration risk. We would consider this as winning the right race too well. Taiwan isn't diversified across tech cycles the way Japan or South Korea are. It's deeply optimized for one trend: AI infrastructure. That's powerful when demand is strong, but vulnerable if spending slows or geopolitical intervention happens, or maybe if there is, in fact, an AI bubble. Relative outperformance also raises expectations abroad and scrutiny. The more Taiwan pulls ahead, the harder it becomes to decouple markets from politics. And leadership bring leverage, but also exposure. I'm going to talk about that, the decoupling from global markets, very soon. But right now, let's continue with another story about Taiwan's growth. Consumer spending in Taiwan remained resilient in 2025, with credit card transactions rising 6.65% year on year to 4.14 trillion new Taiwan dollars in the first 10 months. Growth has been driven by overseas travel, online shopping, and digital payment adoption. Banks reported double-digit growth in cross-border spending and mobile payments, particularly among consumers aged 30 to 49. Hey, that's my age group. Insurance premiums, travel, and e-commerce topped spending categories, while small-value digital payments grew fastest. Financial institutions expect spending momentum to continue into 2026, supported by experiential consumption and expanding digital ecosystem. So, on the surface, this looks like healthy domestic demand, but is not evenly spread. We would argue that most of this spending comes from a specific demographic, the middle-aged, and unfortunately, I am in that demographic, digitally fluent consumers with disposable income. That's not the entire economy. Rising card usage reflect confidence, yes, among those doing well, but not necessarily broad-based wage growth. It also leans heavily on overseas travel and imports, which don't always feed back into domestic investment. Strong consumption here doesn't contradict overheating concerns. It can actually reinforce them. Now, let's talk about the stock market, or in fact, Taiwan's IPO market, which is the initial public offering market. It's where private companies sell shares to the general public for the first time, transitioning into a public company to raise significant capital for growth. And that's been happening a lot here in Taiwan over the year 2025. Now, this reflected strong investor appetite and high valuations, particularly for technology and AI-linked firms. No surprise there. New listings benefited from buoyant markets and strong retail participation, with capital raised flowing into sectors aligned with Do you want to take a guess? Semiconductors, servers, advanced materials, and automation. The surge signals confidence in Taiwan's growth trajectory and its role in global tech supply chain. Regulators and analysts say the depth of the IPO pipeline reflect both corporate expansion plans and investor willingness to fund future growth stories. Now, booming IPOs are often read as confidence, but they're also a late cycle indicator. So I would caution that record fundraising usually appear when firms feel conditions may not stay this favorable forever. You want to get that capital now in case there is some shocks coming your way. Companies list when valuations are rich and financing is easy, but that doesn't mean the story is strong. It means timing matters. IPO waves often precede normalization. For policymakers, this raises questions about capital allocation. How much funding is going into productivity and how much is just riding that momentum? Now, all the stories we've told you so far makes it sound like 2025 was on the up and up. And truly, it might be. Taiwan's National Development Council warned that the economy may be approaching overheating after its composite economic indicator flashed a third consecutive yellow to red signal. That's strong AI-driven demand, solid export, rising industrial production, and buoyant retail activity, which pushed the index to the quote-unquote red threshold. While growth is expected to continue into 2026, the NDC cautioned that high base effects, tariff negotiations, and policy calibration could pose challenges ahead. Now, this is the counterweight to every upbeat headline. All right, overheating doesn't mean collapse, it means strain. I would probably emphasize that policymakers worry less about growth itself than about imbalance. When AI demand props up manufacturing, export, stocks, and sentiments all at once, the margin for error shrinks. Any disruption like tariffs, geopolitical shocks, or a pause in capex would ripple quickly. This warning isn't a call to slow down blindly, but a reminder that sustainability matters as much as speed. Now, all of these strong numbers is not everything pointing in the same direction. In December, Taiwan's Consumer Confidence Index actually dipped. It wasn't a sharp dip, but it was enough to stand out, especially after a year filled with record highs and upbeat forecasts. And that caution isn't coming out of nowhere, because a growing share of Taiwan's economic momentum now depends on decisions made half a world away. That's in the United States. Tariff negotiations are still unresolved. Talks of reciprocal measures, especially around semiconductors, continue to hand over the outlook. And while AI exports are driving growth, they employ only a fraction of Taiwan's workforce, leaving many households watching these gains from the sidelines. So even as market surge and indicators flash strong, everyday confidence is starting to wobble a bit, not because people doubt Taiwan's capabilities, but because the future feels increasingly tied to forces beyond their control, and that's why the next batch of stories shift. The first story, the United States remained Taiwan's largest debtor for the 41st consecutive quarter. 41st. I mean, we're approaching half a century. With Taiwanese banks' exposure to the U.S. rising to nearly $199 billion by the end of September. That figure now dwarfs exposure to China, who sits below $50 billion, constrained by regulatory limits and cautious sentiments. So the gap between U.S. and China exposure has widened to a record of $149 billion. Luxembourg and several other advanced economies also saw increased exposure, but none close to the U.S. Together, the top 10 debtors markets now account for nearly 3/4 of Taiwan's total international claims. Now, this is financial alignment, not just trade. I would say that stress that banking exposure reveals where risk is willingly absorbed. Taiwan's capital is overwhelmingly parked in the U.S. system. A bet on stability, liquidity, and political alignment. Taiwan becomes sensitive not just to U.S. growth, but to U.S. policy shifts. Tariffs, regulatory changes, or financial tightening travel quickly through these channels. The widening gap suggests confidence in the U.S., but also shrinking room to maneuver anywhere else. Case in point, this next story, U.S. has granted TSMC a 1-year license allowing it to continue importing U.S.-made chip-making equipment for its Nanjing fab in China. The approval prevents disruption to production of mature node chips, which account for a small but stable share of TSMC's revenue. Similar licenses were granted to Samsung and SK Hynix. The move follows the expiration of prior exemptions under U.S. export controls and reflects Washington's ongoing effort to restrict advanced technology while allowing some limited and managed operations to continue. TSMC emphasized supply stability and customer fulfillment. Now, this is where the quote-unquote hollowed out concern starts to take shape. Consumer confidence index dropped maybe mainly because of this, because I would describe this as managed dependency. TSMC is allowed to operate, but only with carefully drawn boundaries. Mature nodes are fine, advanced capabilities is not, but Taiwan's perspective, this creates a strange equilibrium. Strategic value means at home and in allied markets, while commercial volumes continue in China. It keeps revenue flowing, but it also ties TSMC to a regulatory balancing act that Taiwan itself does not fully control. Stability here is conditional, not guaranteed. So going back to our last story about how Taiwan's largest debtor is the US, we have our hands tied and there's nowhere else to go. In fact, if the US can tell Taiwan's biggest tech giant what it can or cannot do, how much freedom does the market really have to do what it needs to do? Now, on the other hand, TSMC is expected to begin 3nm production at its second Arizona plant in 2027, a year ahead of schedule as AI demand accelerates. Samsung is reportedly upgrading its Texas facility to pursue 2nm production. Major clients, including Tesla, are diversifying suppliers to enhance resilience. Analysts say that early production reflects stronger customer commitments and growing U.S. pressure to localize advanced manufacturing. While the move reduces geopolitical risk and meets policy expectations, it also intensifies competition and raises cost compared with production in Taiwan. Now, this is the other side of hollowing. Capacity moves forward not because Taiwan is falling, but because politics demand redundancy. I would frame this as insurance manufacturing, right? Expensive, slower, but strategically necessary. For Taiwan, the trade-off is stark. Overseas fabs strengthen alliance and reduce single-point failure risk, but they also shift talent, capital, and learning curves away from home to make something that's a bit more expensive offshore. The question isn't whether this is happening, it already is, but about how much Taiwan can externalize without weakening its core advantage. So on one hand, Taiwan is expected to export more to China and give more capitals and talents and equipment investment to the US. Well, what happens with Taiwan itself? If the earlier stories in this episode showed strength, strain, and strategic squeeze, then the final set of stories now show Taiwan is choosing to respond. On one level, the response is confidence. The government is leading a large national delegation of startups to CES, that is the annual tech show in Las Vegas, putting artificial intelligence front and center, not as a concept, but as everyday applications in health, mobility, food, and homes. Winning innovation awards matters less than the signals that ascend. Taiwan doesn't see itself just as a supplier anymore, but a place where systems, products, and ideas are being built. On another level, the response is commitment and cost. Taiwanese firms are pouring capital into the US, Mexico, and beyond, expanding server manufacturing, cloud infrastructure, and supply chains overseas. These investments are not optional. They're the price of staying inside trusted networks, close to customers and aligned with policy expectations in Washington. So I would describe this moment as Taiwan choosing integration over insulation. Rather than pulling back in the face of uncertainty, Taiwan is leaning further into global markets, especially in the US, even as that deepens dependence and raises questions at home. So where does that leave Taiwan as 2026 begins? Well, the economy is strong, the companies are competitive, the government is active, but the path forward, it seems narrow. Every outward move brings opportunity and exposure. Every alignment choices creates trade-offs that don't show up in headline numbers, which brings us to the question that hangs over all of this. Where should Taiwan go from here, and how much is it willing to trade for staying indispensable? And that's where we'll leave it for this week, but continue to follow all these stories here on Beyond the Reefs. Thank you for listening, and we'll catch you next week.